Okay, hi everyone. This is a lecture of Monetary and Financial Economics B2. Today we will cover financial globalization as a first time. Today we will cover these two contents, the international capital market and the gains from trade, and also international banking and the international capital market. Okay, let's move on to the first topic, the international capital market and the gains from trade. So international capital market or international financial market is a market where people from different countries trade assets. So it consists of several markets. For example, the foreign exchange market is where international currency transactions take place. There are four main problems in the international capital market. How have the gains made by each country from international trade increased? What has led to the rapid growth of international financial activity since the early 1960s? What are the dangers posed by the cross-border integration of international capital markets? What can policymakers do to minimize the problems caused by international capital markets while not reducing the benefit as much as possible? So these are main four problems. So there are three types of trade: transaction in goods and services and goods and services. The second one is transactions in goods, services, and assets. Third one is transactions between assets and assets. There are also three types of gain from trade: gains from trade or exchange of goods and services for goods and services. So this is like, for example, countries can concentrate on the most efficient production activities while others import. Okay. The exchange of goods and services for the future goods and services, it means asset. So this transaction is called intertemporal transactions. So in such transactions, home residents can borrow from foreign countries or sell bonds to foreign countries. The third one is transactions between assets and assets. So this is like our example this is like the situation exchange of French real estate for US government bond. Okay. Other things being equal, riskier assets are avoided because people tend to be risk averse or risk aversion. So not only the expected return of the investment, but also the riskiness of the asset influences the demand of risk-averse investors' investment. So such risk-averse investors may not only invest in one type of asset, but also multiple assets with different riskiness. So combining the multiple assets is called portfolio. And by combining foreign and home country assets, investors in each country can diversify risk. For example, let's consider the situation. So the home and there is home resident and foreign resident. So they have the only asset that residents of each country have. So that they only have the land in their own country that can harvest kiwi every year. So they can harvest kiwi every year. So kiwi harvest is 100 tons in home country and 550 tons in a foreign country, or 50 tons in the home country and 100 tons in a foreign country. So there are two cases. First one is good harvest and the other is the bad harvest. The average yield is 75 tons in both countries, but it's unknown whether good or bad harvest every year. So there is uncertainty about the QE harvest. Now suppose that ownership of the respective assets of the home country and the foreign country can be exchanged. So this is the international transaction of assets. For example, home citizens. For example, if home citizen owns 10% of foreign land, then he or she has the right to receive 10% of foreign QE harvest for that year. So then, what kind of transaction would occur? The answer is home resident buy 50% of the foreign land and give 50% of the homeland to the foreigners. If this year is a good harvest year for the home, then in the foreign country, this is a bad harvest year. Then home student can get half of the home harvest and half of the foreign harvest. So this is 75 tons. So the home resident can get 75 tons if the year is good for the home. When the year is bad harvest for the home, then foreign country faces a good harvest. Then home residents can get half of the home harvest and half of the foreign harvest. So it's gonna be 75 tons. So then home students can get 75 tons when a good harvest year. So in a good harvest year. Sorry, in a bad harvest year. So in a bad harvest year, the home citizens can get 75 tons. Then you notice that home citizens always get 75 tons every year for sure. So average earnings remain unchanged, 75 tons, but only risk is eliminated by the transaction of international assets. In reality, not all risks can be eliminated, but they can be mitigated. So one of the main functions of international capital market is to ensure risk diversification. So international capital markets provides the opportunity for risk diversification for the risk averse investors. So there are two types of asset trade: debt instrument and equity instrument. So debt instruments are instruments that provide for the payment of a fixed amount, generally principal plus interest, regardless of the issuer's economic situation, like bonds and bank deposit. So this is debt instrument. Equity instrument is a terms on the issuer's earnings, etc., with the amount paid out depending on the circumstances. So the amount of paid out depends on the economic situation of the lenders of the borrowers. So this is equity instrument. For example, equity instruments consists stocks, equity in a QE in the previous example. Investors chose how to divide their portfolios into these two categories, debt or equity. However, the actual payout may depend on the price levels and exchange rates. So even if the instrument is debt instrument, the actual payout may change depending on the price levels and exchange rate. Also, it may be paid out. It may not be paid out in the event of government seizure of foreign owned assets or corporate bankruptcy. Assets such as unrated corporate bonds are more like equity due to the uncertain financial condition of the issuer. So the differences between debt and equity are sometimes unclear, because some equity is more like bond, and some bonds are more like equities. Okay, let's move on to the international banking and the international capital market in the next video.